Let me tell you something that might surprise you. For most of my career, people have called me a value investor, someone who buys cheap stocks and holds them forever, someone who avoids growth stocks because they are too expensive and too risky. And in many ways, that characterization is correct. I have made billions buying undervalued businesses and holding them while their intrinsic value became recognized. But here is what people miss. I have also made some of my biggest fortunes buying growth stocks, not speculative growth stocks, not unprofitable companies with exciting stories, but genuinely exceptional businesses in the early stages of long-term growth trajectories. Businesses that I bought when they were already successful, but before most people recognized just how dominant they would become. I bought Coca-Cola in 1988 when it was already one of the largest beverage companies in the world. But it was still in the early stages of international expansion. Over the next decade, that stock made me billions. I bought American Express in the 1960s after a scandal temporarily depressed the stock price, but the business was just beginning to dominate payment processing. That investment made me a fortune. I bought Apple starting in 2016 when the company was already worth over $600 billion. People said I was late. People said Apple was mature. But Apple was actually in the early stages of its transformation from a hardware company into a services ecosystem. That investment has made Berkshire over $100 billion. Do you see the pattern? I am not afraid of growth stocks. I am afraid of stupid prices. And there is a massive difference between those two things. A growth stock at a reasonable price can make you wealthy beyond your imagination. A growth stock at a stupid price will destroy your capital, no matter how good the business is. The key is identifying truly exceptional businesses with long runways for growth and buying them at prices that make sense relative to their future earnings power, not their current earnings, their future earnings 5 years, 10 years, 20 years from now. And that is exactly what I am going to share with you today. 4 growth stocks that I believe have the characteristics necessary to make ordinary investors into millionaires over the next 5 years, not through luck, not through speculation, but through the simple power of owning pieces of exceptional businesses during periods of explosive growth. These are not small companies that might succeed or might fail. These are established businesses that have already proven their models, that are generating substantial revenues and in most cases profits, but that are still in the early stages of massive growth opportunities that most investors do not yet appreciate. Before I reveal these 4 stocks, let me give you the framework I use to identify genuine growth opportunities versus speculative gambles. Because most people who buy growth stocks are actually gambling, not investing. They are buying stories, not businesses. They are buying hope, not economics. And they end up losing money even when they pick companies that eventually succeed because they pay prices that can never be justified. Here is my framework. First, the business must already be generating significant revenue. I do not invest in ideas. I invest in proven business models. If a company is not already serving real customers and generating real revenue, I cannot evaluate whether the business actually works. Second, the business must have a clear path to sustain profitability if it is not already profitable. I am willing to tolerate current losses if those losses are strategic investments in growth that will lead to substantial future profits. But there has to be a credible path, not a hope, a path with clear unit economics. Third, the business must have a genuine competitive advantage that will allow it to capture and maintain market share as the industry grows. Growth industries attract competition. If the business does not have a moat, competitors will erode margins and returns. Fourth, the addressable market must be enormous and the company must still be in early stages of penetrating that market. I want businesses where they could triple or quadruple revenues and still have significant runway left. Fifth, management must be both competent and aligned with shareholders. I need to trust that the people running the business are making decisions for the long term, not to hit quarterly numbers or cash out their stock options. And sixth, the valuation must be reasonable relative to the growth potential. I am willing to pay premium prices for premium businesses, but there are limits. If the stock price already assumes perfection and decades of flawless execution, there is no margin of safety. I want to buy growth stocks where the market is underestimating either the size of the opportunity or the company's ability to capture it. Those 6 criteria eliminate 99% of the stocks that get labeled as growth stocks. Most growth stocks are really just expensive stocks with good stories. They fail one or more of these tests. But when I find businesses that pass all 6 tests, those are the opportunities that can genuinely create life-changing wealth. And right now I see 4 stocks that pass every single test. Let me tell you about the first one. The first growth stock that will make millionaires over the next 5 years is Amazon. Now I know what you are thinking. Warren, Amazon is already one of the largest companies in the world. It is worth over $1 trillion. How is that a growth stock? And that reaction is exactly why this is an opportunity. Most investors look at Amazon's market cap and assume the big gains are behind it. They are completely wrong. Amazon is still in the early stages of several massive growth opportunities, and the market is dramatically underestimating how profitable this business will become. Let me explain why Amazon will be worth substantially more 5 years from now, and why investors who buy today will make fortunes. Amazon operates 3 businesses. Each one is in the early stages of enormous growth. And when you combine them, the growth trajectory is extraordinary. First, there is the e-commerce business that everyone knows. Amazon has trained billions of people to expect fast, convenient delivery of almost anything. And that behavior is permanent. You cannot reverse it. But here is what most people miss. Amazon's e-commerce business is still in early innings globally. In the United States, e-commerce represents about 15% of total retail. It will be 30% within 5 years. That alone doubles the addressable market. But internationally, e-commerce penetration is even lower. In India, in Southeast Asia, in South America, in Africa, e-commerce is just beginning. Amazon is building infrastructure in these markets right now. Warehouses, delivery networks, payment systems. Over the next 5 years, these international markets will explode. And Amazon will capture the dominant share because they are the only company with the capital and expertise to build the necessary infrastructure. Second, there is Amazon Web Services. This is the most important and most misunderstood part of Amazon's business. AWS provides cloud computing infrastructure to companies around the world, and cloud computing is still in the very early stages of adoption. Most companies still run the majority of their technology infrastructure in their own data centers. Over the next 5 years, that will flip. Most companies will move most of their infrastructure to the cloud because it is cheaper, more flexible, and more secure. AWS is already the market leader. They have the most comprehensive services, the most geographic coverage, the deepest expertise. As cloud adoption accelerates, AWS will grow 30 to 40% per year for the next 5 years. And this business generates profit margins of 30% or higher. Every dollar of AWS revenue is far more valuable than a dollar of retail revenue. 5 years from now, AWS will be generating over $200 billion in annual revenue with profit margins that would make it one of the most profitable companies in the world if it were standalone. But it is hidden inside Amazon, so most investors do not properly value it. Third, there is the advertising business. Amazon knows what you are shopping for at the exact moment you are ready to buy. That makes their advertising incredibly valuable. When you search for running shoes on Amazon, an ad for running shoes converts at 10 times the rate of an ad on social media. Amazon's advertising business is already over $40 billion and growing 40% per year. This is nearly pure profit because the infrastructure exists for the retail business. 5 years from now, this will be a $150 billion business with profit margins over 50%. Now, let me tell you what most analysts completely miss. They model these 3 businesses separately and add them up, but they miss the compounding effects. Every customer Amazon adds to retail makes AWS more valuable because Amazon uses its own services and drives innovation. Every AWS customer makes the advertising business more valuable because AWS customers often become retail partners. Every advertising dollar makes retail more profitable. The three businesses create a flywheel where each one accelerates the others. 5 years from now, Amazon will be generating over $1 trillion in revenue with operating margins approaching 15%. That is $150 billion in operating profit. Compare that to today, where operating profit is roughly $30 billion. Amazon's profitability will increase 5 times while revenue doubles. That combination of growth and margin expansion will drive the stock price substantially higher. And I have not even mentioned the new businesses Amazon is building. Healthcare, where Amazon is disrupting pharmacies and primary care. Financial services, where Amazon will become one of the largest consumer lenders. Logistics services, where Amazon is building a network that competes with UPS and FedEx. Entertainment, where Prime Video is becoming a major streaming competitor. Each of these businesses is relatively small today. 5 years from now, each will be generating tens of billions in revenue. So when I say Amazon is a growth stock that will make millionaires, I am saying you are buying a collection of businesses that are all in early stages of massive growth with operational leverage that will dramatically expand profitability at a valuation that does not yet reflect how profitable this company will become. If you invest $50,000 in Amazon today and hold for 5 years, I would not be surprised if that position is worth $200,000 or more. That is millionaire making wealth creation. The second growth stock that will make millionaires is Visa. Now this might surprise you even more than Amazon. Visa is already a massive company worth over $400 billion. It has been around for decades. How is this a growth stock? Because Visa is in the very early stages of the largest payment transition in human history. And most investors have no idea how big this opportunity is. Let me explain what is happening and why Visa is perfectly positioned to capture most of the value. The world is moving from cash to digital payments. That sentence is simple, but the implications are staggering. Today, roughly 85% of global transactions by volume are still conducted in cash. In developing countries, cash usage is even higher. Over the next 5 to 10 years, the majority of those cash transactions will move to digital payments. Credit cards, debit cards, mobile payments, all running on payment networks. And Visa is the largest and most dominant payment network in the world. Every time someone uses a Visa card anywhere in the world, Visa collects a small fee, usually less than 1% of the transaction value. That fee seems tiny, but when you multiply it by trillions of transactions, it becomes an extraordinary business. Visa processed over $14 trillion in payment volume last year. They collected about $30 billion in revenue and generated over $20 billion in profit. Those are incredible margins. 65% net profit margins. But here is the key point. That $14 trillion in payment volume represents only a small fraction of global economic activity. Total consumer spending globally is over $50 trillion per year. Most of that is still cash. As cash converts to digital, Visa's addressable market triples or quadruples, and Visa does not have to do anything special to capture this growth. They just have to maintain their existing relationships with banks who issue cards and merchants who accept them. The secular trend toward digital payments does the work for them. Now, let me tell you about the growth drivers that will make Visa extraordinarily valuable over the next 5 years. First, emerging markets. In India, in Africa, in Southeast Asia, hundreds of millions of people are getting their first bank accounts and their first payment cards. These markets are leapfrogging directly to digital payments, skipping the check writing phase that developed markets went through. Visa is establishing dominant positions in these markets right now. 5 years from now, Visa will be processing more payment volume in India than in the United States. And those volumes will grow for decades because these populations are young and growing. Second, new payment methods. Visa is not just cards anymore. They are the infrastructure behind Apple Pay, Google Pay, Samsung Pay, and virtually every digital wallet. When you tap your phone to pay, you think you are using Apple Pay, but the transaction is actually running on Visa's network. Visa is building the rails that all digital payment innovations run on. As new payment methods proliferate, Visa's volume grows. Third, B2B payments. Business-to-business payments are still predominantly checks and wire transfers. Slow, expensive, inefficient. Visa is building products to digitize B2B payments. This market is even larger than consumer payments. As businesses adopt Visa's B2B products over the next 5 years, it will add trillions in payment volume. Fourth, value-added services. Visa is no longer just a payment network. They provide fraud prevention, data analytics, loyalty programs, and other services to banks and merchants. These services generate higher margins than basic payment processing. As these services scale, Visa's profitability increases. Here is why Visa is such a perfect business. It requires almost no capital investment. Visa does not lend money, so they have no credit risk. They just process transactions. They do not own physical infrastructure that becomes obsolete. They own a network that becomes more valuable as more participants join. And they have extraordinary pricing power because merchants cannot afford to not accept Visa. If a merchant does not take Visa, they lose customers. That gives Visa the ability to slowly raise prices over time without losing volume. 5 years from now, Visa will be processing over $25 trillion in payment volume at current take rates. That is over $50 billion in revenue. With operating margins near 70%, that is $35 billion in operating profit. Visa will also be buying back massive amounts of stock because they generate far more cash than they can invest in the business. The combination of earnings growth and share count reduction will drive earnings per share up 15 to 20% per year for the next 5 years. That means the stock price will at minimum double, more likely triple. A $50,000 investment today becomes $150,000 to $200,000 in 5 years. And you collect growing dividends the entire time. That is Millionaire making wealth for patient investors. The third growth stock that will make Millionaires is Taiwan Semiconductor Manufacturing Company, or TSMC. This is the most important company most people have never heard of. TSMC manufactures the most advanced semiconductor chips in the world. Not designs them, manufactures them. Companies like Apple, NVIDIA, AMD, and Qualcomm design chips, but they do not have factories to make them. They all rely on TSMC to actually manufacture their chips. And TSMC has a monopoly on the most advanced chip manufacturing in the world. Nobody else can make chips at the bleeding edge of technology. Not Intel, not Samsung, nobody. That monopoly position is the foundation for extraordinary wealth creation over the next 5 years. Let me explain why semiconductors are about to enter a golden age and why TSMC will capture most of the value. Every technology trend that matters requires more advanced chips. Artificial intelligence requires chips that can perform trillions of calculations per second. The AI models that power ChatGPT and similar applications run on NVIDIA chips manufactured by TSMC. As AI adoption explodes, demand for these chips will grow exponentially. TSMC cannot make them fast enough. They are sold out for years. Electric vehicles require far more semiconductors than traditional cars. A modern EV has over 3,000 chips controlling everything from battery management to autonomous driving features. As EV adoption accelerates, semiconductor demand grows proportionally. 5G wireless networks require new infrastructure with advanced chips. Data centers need constant upgrades to more powerful, more efficient chips. Consumer devices, from phones to laptops to gaming systems, all require cutting-edge semiconductors. Every single one of these trends drives demand for TSMC's manufacturing capacity. And here is the beautiful part. Building a leading-edge semiconductor factory costs over $20 billion and takes 3 to 4 years. And even after spending that money and time, you still might not be able to match TSMC's manufacturing quality and yields. TSMC has a 15-year head start. They've been investing in advanced manufacturing for decades. The expertise and process knowledge they have accumulated cannot be replicated quickly. That means TSMC's competitive position is protected by enormous capital requirements and time. Any potential competitor would have to invest hundreds of billions of dollars over a decade to catch up. Nobody is doing that. Intel tried and failed. Samsung is trying and falling further behind. TSMC's monopoly is secure for the foreseeable future. Now let me tell you why TSMC will make millionaires over the next 5 years. First, volume growth. TSMC's revenue will grow 15 to 20% per year as demand for advanced chips outstrips supply. They are building new factories in Arizona, in Japan, in Europe. All of those factories will be running at full capacity the day they open. Second, pricing power. When you have a monopoly on something essential, you can raise prices. TSMC has been increasing prices and customers pay because they have no alternative. Those price increases flow directly to profit margins. Third, operational leverage. As factories reach full utilization, the fixed costs get spread over more production. Profit margins expand significantly. TSMC's operating margins are currently around 40%. 5 years from now, they will be approaching 50%. That margin expansion combined with revenue growth drives extraordinary profit growth. Fourth, strategic importance. Governments around the world have recognized that semiconductor manufacturing is a national security issue. They are providing subsidies and incentives for TSMC to build factories in their countries. The United States is giving TSMC billions in grants and tax credits to build factories in Arizona. These subsidies reduce TSMC's capital costs and increase returns. 5 years from now, TSMC will be generating over $120 billion in revenue with operating margins near 50%. That is $60 billion in operating profit. The company will be worth over $1 trillion. Today, it is worth around $500 billion. Your investment doubles at minimum, more likely triples, as investors recognize that TSMC has one of the most durable monopolies in business history, and you are not speculating on some future technology. You are buying the company that makes the chips that power everything technology related. As long as technology matters, and it will matter more every year, TSMC wins. A $50,000 investment becomes $150,000 to $200,000 in 5 years. The fourth growth stock that will make millionaires is Costco. Now, I know what you are thinking. Warren, Costco is a retailer. It has been around for 40 years. How is this a growth stock? This is exactly the kind of thinking that causes investors to miss opportunities hiding in plain sight. Costco is not just a retailer. Costco is one of the most powerful business models ever created, and it is still in the early stages of global expansion. Let me explain why Costco will be worth dramatically more 5 years from now and why this is one of the safest ways to build wealth. Costco's business model is brilliant in its simplicity. They sell products at the lowest possible prices, often at or below cost. They make almost no profit on merchandise. Instead, they make their profit from membership fees. Customers pay $60 to $120 per year for the privilege of shopping at Costco. And once customers are members, they shop frequently and spend large amounts because the value is so compelling. This creates a flywheel. Low prices attract members. More members allow Costco to negotiate better prices with suppliers because of volume. Better prices attract more members. The flywheel spins faster every year, and the membership fee model is extraordinary because it is predictable, recurring revenue with almost no cost to service. Costco collects over $4 billion per year in membership fees. That is almost pure profit. And membership renewal rates are over 90%. Once someone becomes a Costco member, they stay a member for life. Now, let me tell you why Costco is a growth stock. First, they are still expanding in the United States. Costco has only about 600 warehouses in America. The country can easily support 1,000. As they open new warehouses, each one generates over $200 million in annual sales and attracts 60,000 members. That is millions in annual membership fee revenue from a single warehouse. Second, international expansion. Costco is just beginning to penetrate markets like China, Japan, Korea, Australia, and Europe. When Costco opens a warehouse in China, 20,000 people show up on opening day. The demand is extraordinary. Chinese consumers love the Costco model. High-quality products at low prices with a treasure hunt shopping experience. Costco will open hundreds of warehouses in China over the next decade. Each one will be more productive than U.S. warehouses because of population density. Third, e-commerce. Costco has historically been a warehouse business, but they are now building out online ordering with same-day or next-day delivery. This allows Costco to serve members who do not want to drive to a warehouse but still want Costco's pricing and product selection. The e-commerce business is growing rapidly and will add billions in incremental sales. Fourth, services expansion. Costco is no longer just selling merchandise. They sell gasoline at a discount, generating massive volume. They sell pharmacy services, optical services, hearing aids, photo printing, travel booking. All of these services increase the value proposition for members and generate additional profit. Fifth, membership fee increases. Costco raises membership fees every 5 or 6 years. The last increase was in 2017. Another increase is coming soon. When they raise fees by even $10, that is over $1 billion in additional profit, straight to the bottom line. Here's why Costco is such a perfect business for building wealth. The model is proven and durable. Costco has been executing the same strategy for 40 years. There is no risk that the business model will stop working. The competitive moats are strong. Competitors like Walmart and Target cannot match Costco's prices because they do not have the membership fee model to subsidize low prices. Amazon cannot replicate the treasure hunt experience and the social aspect of shopping at Costco. The management culture is exceptional. Costco treats employees well, pays them above market wages, and promotes from within. This creates consistency and institutional knowledge. The growth runway is long. Costco has plenty of room to expand domestically and internationally for decades. 5 years from now, Costco will have over 800 warehouses generating over $300 billion in revenue. Membership fees will exceed $6 billion. The company will be earning over $8 billion in profit. And the stock, which currently trades at a premium valuation, will trade at an even higher premium because investors will recognize that Costco is one of the most durable compounding machines in existence. A $50,000 investment today will be worth $150,000 to $200,000 in 5 years. And you can shop at Costco the entire time, enjoying the same low prices that create value for shareholders. It is one of the rare situations where your interests as a customer and as a shareholder are perfectly aligned. Now let me bring this together. Why will these 4 stocks, Amazon, Visa, TSMC, and Costco, make millionaires over the next 5 years? Because they all share characteristics that drive long-term wealth creation. They operate in growing industries with secular tailwinds that will persist for decades. E-commerce, digital payments, semiconductors, and discount retail are all industries with years of growth ahead. They have genuine competitive advantages that protect their market positions. Amazon's infrastructure and ecosystem, Visa's network effects, TSMC's manufacturing monopoly, Costco's membership model. These moats are durable and in some cases widening. They generate substantial cash flow that can be reinvested in growth or returned to shareholders. None of these companies need to constantly raise capital to fund operations. They are self-funding growth machines. They have excellent management teams that think long-term and make rational capital allocation decisions. These are not promotional CEOs trying to pump stock prices. These are operators building enduring businesses. They are still in relatively early stages of large opportunities. Despite being established companies, each has long runways for growth, and perhaps most importantly, they are all reasonably valued relative to their growth prospects. None of these stocks are cheap, but none are priced for perfection either. There is margin of safety in each investment. If you invested $50,000 equally across these 4 stocks today, you would own approximately $12,500 of each. 5 years from now, I would expect each position to be worth somewhere between $30,000 and $50,000. That turns your $50,000 investment into something between $120,000 and $200,000. And if you reinvest the dividends that Visa and Costco pay, the numbers are even better. But here's the most important point. This is not speculation. This is not gambling on unproven businesses or hoping for lucky outcomes. This is investing in established, profitable, growing businesses with competitive advantages and long runways. The risk is not that these businesses will fail. The risk is that growth might be slower than expected or valuations might not expand as much as I anticipate. But even in disappointing scenarios, you are very unlikely to lose money owning these 4 stocks over 5 years. The downside is protected by business quality. The upside is substantial if these companies execute on their opportunities. That is the ideal risk-reward profile for building wealth. Now, I want to address something very important. Some of you are thinking, Warren, I do not have $50,000 to invest. Does this advice apply to me? Absolutely. The principles are identical regardless of your starting capital. If you can invest $5,000, invest $1,250 in each of these stocks. If you can only invest $500 per month, divide it equally among the four. Dollar cost averaging into these positions over time is actually a superior strategy for most people because it removes the pressure of market timing. You buy more shares when prices are lower and fewer when prices are higher. Over 5 years, you will accumulate meaningful positions, and those positions have a genuine chance to change your financial life. Let me tell you a story that illustrates this point. In 1994, a young secretary working at Berkshire Hathaway started investing $100 per month in Berkshire stock through the employee stock purchase plan. She was not wealthy. She was not a finance expert. She just consistently invested a small amount every month for 20 years. By 2014, her position was worth over $700,000. She became a millionaire by continuing to invest through retirement. She did not do anything clever. She just consistently invested in a great business and held for decades. That is the power of combining time, consistency, and business quality. You can do the same thing with these four stocks. But I need to give you a warning. The path will not be smooth. Over the next 5 years, there will be market crashes. There will be quarters where these companies disappoint. There will be times when the stocks drop 20 or 30 or even 40%. When that happens, and it will happen, you will be tempted to sell. You will see negative headlines. You will hear experts predicting doom. Your friends and family will tell you to get out. That is exactly the moment when you need to hold or even buy more. Every significant fortune I have made has required holding through periods when it looked like I was wrong. I bought Coca-Cola in 1988. Within 2 years, the stock had dropped significantly. People told me I overpaid. I ignored them and held. That investment made me billions. I bought Apple starting in 2016. The stock proceeded to drop multiple times by 20% or more. I held and bought more. That investment has made Berkshire over $100 billion. The difference between investors who build wealth and those who stay poor is not intelligence. It is emotional discipline. The ability to hold great businesses through volatility, the ability to ignore short-term noise and focus on long-term business performance. If you buy these four stocks and sell them the first time they drop 20%, you will lose money. But if you buy them and hold them through whatever volatility comes continually adding to your positions when you have capital available, you will build substantial wealth. That is not a promise. That is a logical outcome based on owning pieces of exceptional businesses during their growth phases. Let me give you one final framework for thinking about these investments. When you buy a stock, you are not buying a ticker symbol. You are not buying a line on a chart. You are buying partial ownership of a real business. Amazon is a real business serving hundreds of millions of customers every day. Visa is a real business processing payments that enable commerce globally. TSMC is a real business, manufacturing chips that power modern technology. Costco is a real business, providing value to over 100 million member households. As long as these businesses continue serving customers effectively and growing their operations, the stock prices will follow. Short-term price movements are noise. Long-term price movements reflect business performance. If you can internalize that concept, if you can train yourself to think like a business owner rather than a stock trader, you will make better investment decisions automatically. So here's what I want you to do. If you have capital available to invest, consider building positions in these four stocks. If you do not have capital now, start setting aside whatever you can afford every month with the intention of building these positions over time. Open a brokerage account if you do not have one. Set up automatic investments if possible. Remove friction from the process of investing. And then commit to holding these positions for 5 years minimum, regardless of what happens to the stock prices in the short term. Check the businesses, not the stock prices. Read the quarterly earnings reports. Pay attention to whether revenues and profits are growing. Pay attention to whether the companies are executing on their strategies. If the businesses are performing, the stock prices will eventually reflect that performance. 5 years from now, come back and look at your portfolio. I am confident you will be very pleased with the results. And if you continue holding beyond 5 years, which I recommend, you will be even more pleased, because these are not 5-year businesses. These are decades-long compounding machines. The wealth creation does not stop in 5 years. It accelerates. But you have to take the first step. You have to make the decision to invest. You have to commit to the strategy. And you have to follow through with discipline. Most people never do this. They talk about investing. They read articles about investing. But they never actually invest consistently in great businesses and hold through volatility. That is why most people never build significant wealth. Not because they could not, because they would not. You have the opportunity right now to do something different, to invest in 4 exceptional businesses that are positioned to grow dramatically over the next 5 years, to build positions that could genuinely change your financial future, to develop the discipline and patience that creates lasting wealth. The question is not whether these stocks will make millionaires. The question is whether you will be one of them. That choice is entirely yours. Choose wisely. Choose patience. Choose great businesses and let time and compounding do their work. That is how wealth is built. That is how millionaires are made. And that is exactly what these 4 growth stocks will do for investors who have the wisdom to buy them and the discipline to hold them. The opportunity is in front of you. Now you must decide what you will do with it.